Hello and welcome back. Today I want to talk about Sweetgreen, which is a restaurant that's having an IPO this coming Thursday, the 18th. You can see here. It's going to IPO on the stock exchange. It is projected to have an opening price of $23 to $25, which is about a $22.7 billion market cap. So I want to take this time just before the IPO to discuss what I think of the business behind it. So just so you know, as a bit of background, whenever there's a company that goes public, they have to file what's called an S1. The S1 is basically an outline of all the documents going over their revenues, a pitch to the public of what it is, and they use this as a bit of a presentation. So here's some of the restaurants that they do. They do salads and fresh bowls. Um, and so, mostly this is just photos, but we can see farther down, they have a bunch of numbers. So I dug in yesterday and came up with some numbers, so I wanted to discuss those with you here. So in 2021, they're projecting $303 million of revenue. And here are the number of stores that they have currently. You can see this is the number of stores, the revenue, and the revenue per store, which is divided. This is in millions. This is just singles. So they had 29 stores. Now they have 140. And you can see here the revenue per store and how it's grown. We can see here that they were growing quite nice, actually. They had 37% growth basically between 2014 to 2019. Now, obviously, there was a huge pullback because of COVID. But even with COVID, they've grown since inception, since 2014. Not since inception, but since 2014, they've grown at 28% per year in total revenue. And revenue per store has grown at about 10% a year, which is really good and really strong. Now, part of that could be inflation, part of that could be they're getting better brand awareness and they're becoming more efficient. A big thing they focused on in the S1 was the percentage of digital orders. Let me see if I can find that. Oops. Digital. Here, yeah. 47% of our revenue coming through our own digital channel. So this is very similar to Chipotle, which is really how to focus on digital as the dominoes. Those are really things that have turned the businesses around is by owning the customer through digital. You have a much closer relationship with the customer. You can poke them, say, hey, on other Sweetgreens, you can learn about their preferences. If they're not showing up, you see that they ordered a bowl every other day and suddenly they haven't gone a couple weeks, you can send them a notification, 10% off, try and get some information. So you have a lot of these companies are trying to go towards digital because you have a much stronger chance of keeping that as an ongoing customer and using the data to improve. So in the S1, they say double. And approximately to double our current footprint in the next 3 to 5 years. Oh, here. We had to open at least 30 domestic stores and approximately double. So I said it took the full 5 years. I guess this should be 2026. But currently they have 140 stores. Let's say they double it to 280, and currently they're at $2.1 million per store. I assume 10% growth per store over the next 5 years, and we get to 3.5 million per store. Now, part of that could be inflation. We've seen higher inflation, and actually, you've seen that. Where was it here? Sweetgreen hikes prices to offset higher wages, better benefits. So again, we've talked about this before. Higher inflation and the tough job market has meant that restaurants have had to increase pay wages and give better benefits, and they're passing those increased costs on to customers. So again, 10% per year, that's what they were growing at on their peak. If we look at let's look at just here. So ignoring their peak, just in total, so it's more like 5% if we include the pandemic years. So, and if you did that instead of 3.5, you'd have 770. So either $770 million in revenue in 5 years if it grows at 5% a year and they double, or 975 million. So again, between 775 and 975 based on what the store growth is and how we think they're going to continue to grow. So I wanted to, because they're actually currently not cash flow positive, they've actually shown negative EBITDA margins, which is pretty bad actually. EBITDA, you can see here they have EBITDA margins of negative 49%, negative 17%, negative 15%. Obviously, some of this had to do with COVID, but even prior to COVID, this is 2019 here, they were losing money. Now, again, it's okay sometimes to lose money in order to grow, and we do expect that one day they'll be profitable again. Who knows when, but this is why I'm trying to say, let's say in 5 years, they've gotten to scale, they have a lot more stores, and they are able to be reasonably profitable, similar to other fast food chains. So because I didn't want to focus on earnings, I chose instead to look at price to sales. So I took a number of other fast food companies. So we have Shake Shack, Chipotle, Domino's, QSR, which is quick serve restaurants, which owns Tim Hortons and Burger King and Wendy's. And then I took the current version of Sweetgreens and the future version of Sweetgreens, and just to look at kind of what they look at from a price to sales ratio. So currently they have revenues of 300 million, which is, we're doing this in billions, so 0.3 billion, market cap of 2.7 billion, and they have a 9 price to sales. And we can see here there's a pretty strong, and this is again a hypothetical. And their 5-year revenue growth was 21%. If you actually take out COVID though, it was, like we said, they were growing at 36%. So you can see here there's a pretty clear correlation between the multiple you got on your sales and your growth. So if they had the strongest growth over the pre-pandemic years, 36%, and they had the highest price. You can see here the companies that were only growing 3% got a 2.6. That's Wendy's. Quick Serve, which grew at 6% a year, has a slightly higher 3.3 price to sales. Domino's grew at 12% a year, got 4. Chipotle had slightly higher, but it's got a much higher price to sales. But you can see here, Shake Shack, 23% growth and 5 price to sales. So again, it's not perfect, but there is a clear correlation between the revenue growth and the price to sales multiple. So again, currently, Sweetgreens has between 21, we could say 28, we could say 36. It depends how you want to measure it. Very high growth though, and they have a very high price to sales. But let's look at the future one in 2026. We're assuming again 0.975, so basically $1 billion. I assume that it got a 4 multiple, so I'm assuming it's about Domino's at that time. You could say 5. And given that, they'd have a market cap of 4.1. If you have 4.1, then you are having, what is your return? You have an 8.7 CAGR. So this means that you'd make about 8.7% per year over those 5 years. Again, it could be bumpy, could have ups and downs, but so that's slightly above average. Obviously, if you think they have a better price to sales, you think they have 5, it could be a great one. If you think that their growth slows, it could be a terrible investment. So, but so far, 2.7 does not sound outlandish if you really think they can grow sales significantly. Actually, let's look at if it was 0.775. If it's 0.775, they'll have a market cap of 3. Not great. 0.9. So again, there's a range, but 2.7 billion doesn't sound too bad. Now, I want to do one more thing, which was the implied growth over the next 5 years. So we have between 0.75, which again, it was like what we said at the low end, and I said on the high end 1.15, so that's 1.15 billion. And what our price to sales multiple is. And based on that, here's what the market cap would be. And then I said, what would our annualized return be given that? So if you think in 5 years they're still going to have a 4 or 5 price to sales, and you think they can get to kind of, let's say 0.85. So that was the midpoint between our low and our kind of realistic. If they get a 5P, it's a pretty decent return. Or sorry, 5 price to sales. Now that's similar to Shake Shack and but if they're closer to Domino's, then it's a little below average. So um, from a valuation standpoint, 2.7 does not sound so unrealistic. Now we'll see if the stock pops. We've seen a lot of stocks jump 100% on the first day. We've seen a couple stocks pull back a lot. I would be interested in this stock. I don't know Sweetgreens personally. I've never tried their food. They don't have any in Canada, but there's clearly a lot of room for expansion. They only have 140 stores. If they really think that fresh salads and stuff, and the people that do eat it though, I have family in the States, they have talked about Sweetgreen and they love it. So the people who like it really do seem to love it. So let's go back to product, like my framework. So first the product. I haven't tried the product, so I can't speak to it. But you can see here they had, where was it? NPS. They talked about their NPS score, Net Promoter Score of 78. Um, so that means people do really seem to like it, the people that eat it. Um, it's salads, it's bowls, it's fresh stuff. And there is definitely growing demand for things that people perceive to be healthier and people don't just want burgers also. There's definitely room in the market for a company like this. So from a product standpoint, I understand the product. Um, the macro environment, how are restaurants doing? There's definitely the fact that I would say one-off restaurants are going to have a tough time in the future. I think you're going to need to have better technology, and things like COVID really had small restaurants where it struggled, but big restaurants like McDonald's, they had cash piles. Sweet Garden here is raising money, so they'll have lots of money. So if there is ever anything where stores need to be shut down or they need to change the way that they operate, they'll be much better able to adapt to the future. So I do think chain restaurants and restaurants with large cash piles are going to be better situated for this future. So again, I'm on the market. I'm on the. I guess I'm positive on the macro. I do think people are having eating out more. There's going to be probably more delivery too. Like we've seen DoorDash has done amazingly successful. And the valuation's okay. So for me, Sweetgreens, if you are a fan and you're a believer, I think it's a buy. I personally am going to stay away from it just because I don't know enough about the product to really feel confident. If this is something and I said, oh my God, this is amazing. Everyone needs to have this. This is going to blow up. I'd probably feel stronger. So to me, this goes back to the valuation checks out. It's really about, do you believe that they can grow like a lot because they really do have to grow. And do you think that their growth pre-COVID is more accurate than their growth since then, where they've seen slowing growth? And do you think that once the world kind of opens up again, we're going to get back to this level of growth, this really high 36 to 28% growth? Or do you think we're going to settle into a more 19-20% growth? Because again, if you think that we're at 25 to 30, this is basically a buy all day. I don't think they're going to have three price sales. So this is really good. But if you think that their growth has slowed, they've lost momentum, or you just think there's not as big a market for a healthy salad fast food place, then it's not as strong an offering. And again, I wouldn't give six price sales if they're not growing as quick. So I would say it's if you think there's slow growth, you're probably in this neighborhood, which is like between below average and maybe just a bit above average. If you think they have great sales, uh, I think you're probably in this range, which is great investment. So that's my analysis of Sweetgreen. Again, the IPO on the 18th. I'm going to be watching the stock, seeing what happens. If it pops the first day, I think it, again, not saying it wouldn't be a good investment, but I would be more interested if it fell the first day to a more evaluation where there's a little more margin for error for me. So, close to 2.2 billion or maybe below 2 billion, I think this is actually a pretty good buy. But over 3.2 billion market cap, I think there's just a little too much risk. Again, not saying it's not going to be a good company. I don't know the future. No one can, but you want to take good risk adjusted uh, investments. So, that means that you don't buy it at any price. You have to have a framework for valuing it, and this is my framework. So hopefully this was helpful. Let me know. Have you eaten at Sweetgreens? What are your thoughts? And are you going to be buying the IPO? Let me know in the comment section below. Thanks so much and have a great day.